Welcome back to the Deep Dive. Today we are really getting into the source code of modern finance.
We are. It's a deep foundational dive into interest rates.
Right. Specifically how they're structured, how they're calculated, and I think most importantly, how they're used to measure financial risk.
Exactly.
Now, if you hear interest rate math, you might immediately think, boring.
Uh-huh. A lot of people do.
But this isn't about just reading tables. This is about understanding the pure underlying mechanics that financial institutions use to price literally every derivative contract, every bond.
And every single risk they take.
Yes. Understanding the zero curve, duration, and convexity is, well, it's really the shortcut to understanding the entire fixed income world.
That's absolutely right. Our mission today is to equip you with the fundamental toolkit, and it's derived heavily from foundational texts on derivatives and quantitative finance.
We're moving past that consumer-level understanding of an interest rate, the number you see on your mortgage statement.
And we're delving into the mathematical truth. How financial markets establish the true time value of money, completely independent of credit risk or any coupon payments.
So what's the roadmap for this engineering project we're about to undertake?
Okay, so we'll begin by clarifying the hierarchy of reference rates. What's truly risk-free and what rates used to be dominant, like LIBOR.
Okay.
Then the technical centerpiece. We're going to learn how experts actually construct the true, pure interest rate curve, the zero curve, using this really ingenious technique called the bootstrap method.
It will actually walk through a calculation.
Step by step. And then finally, we'll move from just valuation to actual risk management by mastering duration and convexity.
The two big metrics.
The two metrics that determine how much money you win or lose when interest rates move.
Okay, let's unpack this, starting with the very building blocks, the reference rates that the global market uses to define the baseline for risk. When we talk about a baseline rate, we almost always start with treasury rates. So the rates on debt instruments issued by the U.S. government, bills, notes, and bonds. Why are these specific instruments considered the closest proxy we have to the risk-free rate in global finance?
It really boils down to a fundamental lack of credit risk. But there's an important nuance there.
Okay.
Credit risk just means the chance that the borrower fails to repay you. For the U.S. government, especially on its dollar-denominated debt, the market consensus is that they are, extremely unlikely to default.
Extremely unlikely is putting it mildly.
It is, and this isn't based on their fiscal strength alone, but on a really unique structural feature they have. They have the power to create the very currency needed to service that debt.
They can essentially print the money.
Precisely. Now, while this does introduce other risks, like inflation risk or currency risk, it functionally eliminates the standard credit default risk that you'd apply to a corporation, a municipality, or an individual.
I see. So treasury rates become this foundational benchmark.
They do. All other rates are basically built by starting with the treasury rate and then adding various risk premiums on top. Things like a credit spread, a liquidity premium, or even political risk.
Historically, for decades, another massive pillar of global finance stood right alongside treasury rates. I'm talking about LIBOR, the London Interbank Offered Rate.
A giant of the old system.
It's being phased out now, but it defined pricing for literally billions in derivatives and loans. What exactly did LIBOR represent, and what was its original perception of risk?
LIBOR was the primary reference rate for global financial markets, and it was designed to capture the average rate at which AA-rated banks could borrow unsecured funds from other banks in the London interbank market.
Unsecured being the key word there.
Absolutely. And before 2007, it was considered very, very close to risk-free. Maybe just a hair above treasury rates, because the credit risk of short-term lending between these huge, highly rated global banks, it seemed negligible.
But the 2007-2008 financial crisis completely shattered that perception. What did that systemic shock reveal about LIBOR?
It revealed that the interbank lending market was anything but risk-free. I mean, banks just stopped trusting each other.
Right.
It reflected extreme counterparty risk. And since LIBOR was an unsecured rate, meaning no collateral was exchanged, it just soared, reflecting immense credit stress in the system.
And that led to its eventual demise.
It did, yeah. That was accelerated by manipulation scandals, of course, but the core financial lesson was that unsecured interbank lending carries significant credit and liquidity risk.
And this whole episode led the market to shift toward rates that do reflect less risk, pushing us toward mechanisms like the overnight index swap, or OIS rates.
And now, alternatives like SOFR, the secured overnight financing rate.
That's the key takeaway from modern financial modeling, isn't it?
It is. For any kind of discounted cash flow analysis, especially in derivative pricing, the market now often uses OIS or SOFR rates. And that's because those transactions are typically collateralized.
So there's something backing the loan.
Exactly. When cash flows are collateralized, the credit risk essentially disappears, which makes those OIS or SOFR rates much, much closer to the true theoretical risk-free rate you need for valuation. It's a profound structural shift from the old reliance on unsecured LIBOR.
Okay, so we have these market-observed rates, Treasury for the credit risk baseline, and ISOFR for collateralized discounting. But the real theoretical foundation for all this rests on the zero rate.
Yes.
This is the rate financial engineers use to truly value cash flows. Can you define the zero rate or the spot rate for us in its purest form?
The zero rate for a specific maturity, let's say time $2, is the rate earned on a hypothetical investment that starts today and delivers a single lump sum payoff only at time $2.
So no coupons, no intermediate payments.
Nothing. Think of it as a pure time premium. It's not influenced by the credit rating of an AA bank. It is the fundamental, true rate of discount for that exact moment in the future.
This brings us to a really crucial point of confusion for a lot of people. The difference between a bond's single advertised yield and these zero rates we use for theoretical price calculation.
A very common point of confusion.
If I buy a 10-year Treasury bond, why can't I just use its yield to discount all of its future payments?
Because the bond yield is really just a convenience, not the underlying truth. The bond yield is simply the single discount rate. It's an internal rate of return, an IRR, that you have to apply uniformly to every cash flow of that bond.
The coupons and the principal.
Right. To make the bond's present value equal to its current market price, it's really just a weighted average, a blended return.
So it's one number that sort of summarizes a whole stream of different payments.
Exactly. But the theoretical truth is that each individual cash flow is its own little zero coupon instrument maturing at a different time.
I see.
A coupon paid in 6 months should be discounted at the 6-month zero rate. A coupon paid in 1 year should be discounted at the 1-year zero rate, and so on. The theoretical price is the sum of all these individually discounted cash flows, each valued using its unique corresponding zero rate.
That's a beautiful concept. It implies that a single bond is actually a portfolio of mini zero coupon bonds.
That's the perfect way to think about it.
Let's use the standard theoretical framework for this. Continuous compounding. Why is continuous compounding using the exponential function? Why is that preferred in complex financial models, even if the market quotes use, say, semi-annual or annual compounding?
Continuous compounding, where interest is calculated and reinvested infinitely often, is just mathematically superior for this kind of work. It treats time as a smooth, continuous variable.
Which is useful for derivatives.
Hugely. In derivative models, where you might be looking at price movements second by second or even microseconds, treating time continuously simplifies the calculus and makes the models far more tractable.
But you still have to adjust for the real world.
Oh, absolutely. You must adjust for market conventions, like the use of semi-annual compounding for most corporate and treasury bonds. But the internal, risk-neutral models generally default to continuous compounding for their elegance.
And we should probably briefly mention that the real world adds another layer of messy detail. Day count conventions.
Yes, a necessary evil. Depending on the instrument and the market, whether it's treasury bonds, corporate debt, or swaps, you have to adhere to specific rules for calculating the actual fraction of the year between cash flows.
For treasury bonds, it's typically actual.
Correct. For corporate bonds, it might be 3360. These conventions just ensure everyone agrees on the precise time $2 in the discounting formula, even if they do introduce some small arithmetic quirks.
Okay, so we've established that the zero rate curve is the fundamental truth required for accurate pricing.
It is.
But as we just discussed, most of the bonds we actually observe trading in the market are coupon paying. So we can see the price of a 5-year 6% bond, and we can calculate its yield. But how do we actually find the pure 4.5-year zero rate that's needed to discount its second-to-last coupon payment?
This is the central engineering feat of fixed income markets. It's a great question. If we relied only on observed zero coupon bonds, our yield curve would be sparse and incomplete.
We'd have huge gaps.
Huge gaps. So the market relies on the bootstrap method to generate a dense, robust zero curve from the prices of these coupon-paying instruments.
It sounds like financial archaeology, like digging up the pure rates that are buried inside these messy coupon bonds.
That's a great analogy for it.
Walk us through the underlying logic of the bootstrap process.
The logic is sequential and self-referential. We start with the shortest maturity instruments that happen to be pure zero coupon bonds like T-bills, and we use them to establish our initial short-term zero rates,
Foundation.
the foundation. Once those are known, we move to the next longest instrument, which is usually a coupon bond. The price of that coupon bond is known, and all of its cash flows, except for the final one, fall on maturities where we've already calculated the zero rates.
Ah, so we use the known short-term zero rates to discount the early coupons. We subtract those values from the total known market price, and whatever is left must be the discounted value of the final payment.
Precisely. That remainder allows us to algebraically solve for the final unknown zero rate that corresponds to the bond's maturity.
And then we just repeat the process.
We then use that newly calculated zero rate as a known factor for solving the next longer bond in the sequence, cascading outward to build the full curve.
This is a fantastic intellectual puzzle. Let's walk through a custom four-instrument example to really solidify this. We're solving for the continuous compounding zero rates, $3 for maturities out to 2.0 years, assuming semi-annual cash flows.
Okay, sounds good. We have 4 instruments starting with 2 T-bills and 2 coupon-paying bonds.
Let's lay out the data. For 0.5 years, we have T-bill A with a cash price of 99.00. For 1.0 year, T-bill B with a price of 97.50. Both have a face value of 100.
Correct. Then at 1.5 years, we have bond C. It has a price of 100.50, a 5% semi-annual coupon, so it pays 2.50 every 6 months.
And finally, at 2.0 years, we have bond D. It's trading exactly at its par value of 100.00, and it has a 6% semi-annual coupon, so it's paying 3.00 every 6 months.
Perfect. That's our data set.
Let's start with step 1, the short end of the curve, the 0.5 year zero rate, which we'll call $9 $5. We use T-bill A for this.
Right. T-bill A is simple. Price is $99 today. You get 100 payoff in half a year. We just apply the continuous compounding present value formula.
So $99 equals 100 times yield rate to the power of negative $4.05 times 0.5.
Exactly. We rearrange that, take the natural logarithm of both sides, solve for $5, and we find that the 0.5 year zero rate is approximately 2.010% per annum. That gives us our starting discount factor.
Done. Step 2. Now we move to T-bill B, the 1.0 year zero rate, 5 1-soners.
Another straightforward calculation. T-bill B has a price of $97.50 and 100 payoff in 1 full year.
So 97.50 equals 100 times $1 to the power of negative $1.0.
Right. Solving this gives us the 1.0 year zero rate, $4.0, which is approximately 2.532% per annum.
And already we can see a positive slope. The 1-year rate is a bit higher than the 6-month rate.
It is. This immediately tells us the market is either expecting rates to rise or it's demanding a small liquidity premium for holding on for that extra 6 months.
Okay, now for the leap in complexity. Step 3, we have to find the 1.5 year zero rate, $25 using bond C.
Right.
Bond C's total price is 100.50, and it has 3 cash flows. $2 at half a year, 2.50 at 1 year, and then the big one, 102.50 at 1.5 years.
And this is where the bootstrap really earns its name. The price of bond C has to satisfy the full present value equation.
So the price, 100.50, is equal to the sum of those 3 cash flows, each discounted by its proper zero rate.
Correct. And we already know the first 2 zero rates, 25 cents and $31. The discount factors for those first 2 coupons are already established from our T-bills. They're 0.99 and 0.9750 respectively.
Okay, so let's calculate the present value of those first 2 coupons and then subtract them from the total price of 100.50s.
The present value of the 6-month coupon is 2.50 times 0.9910, which is 2.4750.
Okay.
The present value of the 1.0 year coupon is 2.50 times 0.9750, which is 2.4375.
So the total present value of those known coupons is 4.9125.
Right. So if the total market price is 100.50 minus that 4.9125 must be the present value of that final large cash flow of 102.5.
And that leaves 95.5875.
Correct. The discounted value of the final payment has to be 95.5875. We then set up the final equation to solve.
And when we solve that algebra for honor 5 0, it yields a 1.5 year zero rate of approximately 4.650% per annum.
Wow, look at that jump. From about 2.5% at 1 year to over 4.6% at 1.5 years. It's a massive implied expectation shift. The curve is getting very steep.
And now, the final step, step 4, the 2.0 year zero rate, $2 zeros, using bond D. This bond trades at par, $100 zero, and pays a $3 coupon every 6 months.
So now we have three known zero rates that we must use for the first three coupons. This calculation really demonstrates the cascading nature of the bootstrap.
So we're discounting 3.0 at the 0.5-year rate, 3.0 at the 1.0-year rate, 3.0 at the 1.5-year rate.
And then finally, the big one of $3.00 principal plus coupon at the unknown 2.0-year rate, $2 zeros.
Okay, we have the discount factors for the first two coupons already. We just need the one for 1.5 years.
We can calculate the present values of the first three coupons.
Uh-huh.
3.00 times 0.990 is 2.9700.
Right.
And $3 times the 1.5-year discount factor, which is u to the power of negative 0.0465 times 1.5, gives us about 2.7977.
The sum of those three known present values is, let's see, 2.97 plus 2.925 plus 2.7977 comes out to 8.6927.
And we subtract this from the total price of 100 zero.
Which leaves 91.3073.
And that remainder must be the present value of the final $103.00 cash flow at the 2-year mark. So 91.3073 equals $103 times $t to the power of negative $3.00.
And solving for that final unknown rate.
We find the 2.0-year zero rate $2 is approximately 5.493%. And we've done it. We've successfully engineered a continuous zero coupon curve, 2.010% for half a year, 2.532% for 1 year, 4.650% for 1.5 years, and 5.493% for 2 years.
This calculation just demonstrates the profound reality that any single yield quote you see for a coupon bond is really just a rough summary.
It is. The true underlying pricing structure relies on this curve.
And once we have this curve, we can immediately derive expectations about the future in the form of forward rates. Let's calculate one. What's the 0.5-year forward rate starting 1 year from now?
The forward rate is the mathematically implied interest rate between two future dates, derived purely from the current zero curve we just built. It reflects the rate required to make two investment strategies completely equivalent.
What are the two strategies?
Strategy A is investing for the full period, say 1.5 years. Strategy B is investing for the shorter period, 1 year, and then reinvesting at the forward rate for that remaining half a year.
And using continuous compounding, the relationship is elegantly simple.
It is. The total return from the long investment has to equal the total return from the short investment rolled over at the forward rate.
We're looking at the period between time 1.0 year and time 1.5 years. And we just derived the rates for those points.
Yeah.
Our 1 celts is 2.532%, and our $1 is 4.650%.
Right. So we use the formula, which is essentially the 1.5-year total rate minus the 1.0-year total rate divided by the time difference. When we crunch those numbers, the implied forward rate, F, comes out to approximately 8.988% per annum.
Wait a minute, say that again? The current 1-year rate is 2.5%, the 1.5-year rate is 4.6%, and yet the forward rate, what the market is implying, the 6-month rate will be 12 months from now, is nearly 9%.
Yes, that is a massive implied rate hike.
What does that mean?
It means the market, as reflected by the current prices of just these four instruments, is expecting extremely steep short-term rate increases in the immediate future. If you were pricing a derivative contract, like a forward rate agreement, that locks in a borrowing rate for that future period.
You'd be using this 8.988% rate.
Exactly. We have just used today's prices to lock in tomorrow's expectations.
So we've now engineered the true foundation of interest rate structure, the zero curve. But the shape of that curve, its slope, it's not arbitrary.
Not at all.
It reflects the collective market's expectations and its demand for compensation against risk. Why does the curve slope the way it does?
The yield curve shape, which is just a plot of yields or zero rates against maturity, is arguably the most important single indicator in all of fixed income. It reflects this delicate balance between expectations of future monetary policy and structural demands for risk premiums.
And there are a few theories that try to explain it.
We have three main theories that attempt to explain its shape.
Let's begin with let's call it the purely academic view, the expectations theory.
Right. The expectations theory argues that the long-term rate is simply the geometrically determined average of the current short-term rate and all the expected future short-term rates.
So it completely ignores risk and liquidity preferences.
Completely. If the curve slopes up, the market expects short-term rates to rise. If the curve is flat, they expect short rates to stay stable. If it's inverted, sloping down, they expect short rates to fall. It's a very elegant, but
A little too simple for the real world.
ultimately, yes. It's an incomplete explanation.
The theory assumes perfect arbitrage between different maturities, forcing them to align based purely on expectations. But the real world has boundaries, which brings us to the market segmentation theory.
This theory completely rejects that idea of arbitrage linking maturities. It posits that investors, by their nature, have rigid maturity preferences. The markets for short, medium, and long-term bonds are largely isolated or segmented.
You mean like a commercial bank focuses on short-term lending?
Exactly, to manage its liquidity. While a massive pension fund or an insurance company, they must focus on long-term bonds to match their decades-long liabilities.
So in this view, the rate for a 2-year bond is set purely by the supply and demand of people who only want 2-year bonds, and it's independent of what's happening in the 30-year market.
Precisely. If there's a sudden surge in demand from institutional investors for a 5-year paper, the 5-year rate will fall relative to the rest of the curve, even if expectations of future inflation remain totally unchanged.
It helps explain some anomalies.
It does, but it fails to account for the fact that professional investors do switch between maturities when the yield spread becomes wide enough to justify it.
Which brings us to the most powerful and I think realistic explanation, the liquidity preference theory. This one incorporates the expectations model but adds a crucial element, compensation for taking on risk.
The liquidity preference theory is really the workhorse of yield curve analysis. It acknowledges that investors, generally speaking, prefer to hold assets that are highly liquid and quickly convertible to cash.
Meaning they prefer shorter-term maturities.
Exactly. Holding a 30-year bond exposes them to way more interest rate volatility and the risk that they might have to sell it at an unfavorable price before it matures.
So to convince an investor to accept that greater risk and that lower liquidity of a long-term bond, you have to pay them extra.
Exactly. They demand a liquidity premium. Therefore, the long-term interest rate is composed of the average expected future short-term rates, just like in the first theory, plus the structural liquidity premium.
And that premium gets bigger the further out you go.
It's positive, and it increases with maturity. So if pure expectations suggested the 30-year rate should be 4%, the liquidity premium might push it up to 5% or 5.5%.
And that explains why the yield curve is upward sloping most of the time.
It is the default, normal shape of the market. Investors are perpetually demanding compensation for risk and lack of liquidity. A flat curve implies the market expects short-term rates to fall just enough to negate that premium.
And the only time the curve actually inverts, sloping downward,
Is when the market expects a steep, sustained decline in future short-term rates. This usually signals a severe economic slowdown or recession that will force central banks to cut rates aggressively. The inverted curve is where the expectation of falling rates finally overwhelms that structural liquidity premium.
We've established the market's language for time and expectation. Now we have to establish its language for risk. If rates move, and they always do, how do we quantify the exact measurable effect on the value of a bond portfolio?
Right.
We're shifting from static valuation to dynamic risk management using two critical tools, duration and convexity.
Duration is the essential starting metric. It provides the single best measure of a bond's price sensitivity to changes in its yield. It translates a rate shock into an immediate percentage change in price.
So conceptually, what is duration? I know there's Macaulay duration, which is the weighted average time until cash flows are received. But in practical risk management, traders use something called modified duration. What's the intuition there?
Think of modified duration, which we can call dollars, as the slope of the price-yield relationship. It tells you exactly how steep that relationship is at the current yield level.
So a high duration bond would have a steep slope.
Exactly, like a zero coupon bond. Its price is highly sensitive to yield changes. A low duration bond, like one with high frequent coupon payments, has a much flatter slope.
And the famous duration formula is essential for hedging. The change in bond price is approximately negative B, the price times D, the duration, times the changing yield.
The negative sign is key, reflecting that inverse relationship. Yields up, prices down.
Let's use the implied numbers from our source material to demonstrate its practical power. Let's say we have a bond trading at a price of 94.203 with a calculated modified duration of 2.653.
Okay. A trader wanting to know the impact of a market move would use this relationship immediately.
Let's examine a 10 basis point yield shock. A basis point is just 1/100%, so 10 BPs is 0.001 in decimal form. Let's say the yield increases by 10 basis points.
Okay, so the estimated percentage change in the bond's price is negative D times the change in yield. That's negative 2.653 times 0.0001.
Which is negative 0.002653, or a loss of about 0.2653%.
Right. And in dollar terms, we multiply that percentage change by the current bond price, the 94.213.
So the change in price is approximately negative 2.24995.
About a 25-cent loss. So if rates rise by just 10 basis points, the bond price is predicted to fall by about 25 cents. That's the essential, fast calculation for reporting risk and setting up hedges.
And this is how portfolio managers use it. If they want to reduce their interest rate risk, they reduce their portfolio's average duration.
And if they expect rates to fall, they increase duration to maximize the price appreciation.
But, and this is a big but, duration is a linear approximation. It's a straight line tangent to a curve. And the actual relationship between price and yield is curved. That brings us to our second, more sophisticated risk measure, convexity. Why does duration fail when rates change dramatically?
Because the further you move away from that single point of tangency, the more the linear estimate deviates from the true price curve. Duration is very accurate for tiny rate movements, but when yields shift by 50 basis points or 100, the approximation error can become significant.
So we need a way to measure and account for the curvature itself.
And that curvature is precisely what convexity measures. It measures the rate of change of duration with respect to the yield. Mathematically, it's the second derivative of the price-yield function,
And it provides a corrective adjustment to the duration approximation.
making the overall price change estimate far more accurate for large moves.
Okay, so we add a convexity term to the equation to catch the error. But what is the intuitive benefit of convexity for the person actually holding the bond?
This is where it gets really fascinating. Nearly all non-callable bonds exhibit what we call positive convexity. The positive curvature means the price increase you gain when rates fall is always greater than the price decrease you suffer when rates rise by the exact same amount.
That sounds like a structural advantage.
Yeah.
You get more upside than downside.
Exactly. Think of the price curve as always bowing slightly upward. This convexity provides intrinsic value, especially in volatile markets. If rates are fluctuating wildly, a high convexity portfolio will consistently outperform a portfolio with low convexity.
Why is that?
Because those favorable asymmetric gains on the downside, when rates decrease, they accumulate faster than the losses on the upside when rates increase.
How do portfolio managers use convexity in practice, beyond just measuring it?
Convexity is crucial for something called portfolio immunization.
Okay.
Immunization is the process of structuring a portfolio to meet a future liability, like a pension payment, regardless of what happens to interest rates, while matching the duration of your assets to the duration of your liabilities handle small rate changes. If rates change significantly, the linear duration estimate fails, and the portfolio could fall short.
So a pension fund, for example, would want to ensure its assets not only match the duration of its liabilities, but also have greater convexity.
That is the ideal goal. If the assets have greater convexity than the liabilities, the portfolio is protected against large volatile rate shocks. If rates move dramatically in either direction, the higher convexity on the asset side ensures that the asset value rises faster or falls slower than the liability value, maintaining solvency.
So duration is your risk measurement.
And convexity is your volatility insurance.
We've spent a lot of time establishing the theoretical structure and the risk measures for individual bonds. But the real catastrophes in finance don't usually start with a single bond.
No, they don't.
They start when institutions fail to manage the aggregate risk created by their customers. This is the problem of asset liability maturity mismatch.
This mismatch is inherent to traditional banking. A bank essentially performs what's called maturity transformation. They take short-term liquid liabilities like your checking account and short-term CDs.
And they use that money to fund long-term illiquid assets, primarily loans and mortgages.
Exactly. Customers demand this mismatch. You want your money available tomorrow, but you want your mortgage to be locked in for 30 years.
And this mismatch exposes the bank to two existential threats, which are often confused. Interest rate risk and liquidity risk. Let's start with the first one, interest rate risk.
Interest rate risk arises when the income from your assets is fixed, but the cost of your liabilities you're funding is variable and short-term. The classic historical example is the savings and loan crisis of the 1980s.
The S&Ls.
That's right. S&Ls were funding long-term fixed-rate mortgages with short-term deposit-based funding.
And then the Federal Reserve, under Paul Volcker, hiked short-term rates dramatically to fight inflation.
Yeah.
What happened to the S&Ls?
Their funding costs, the interest they had to pay to their depositors and wholesale lenders just skyrocketed. They reflected the high new short-term rates, but the income they were getting from their existing mortgage portfolios stayed flat, locked in at old, low fixed rates.
Their profit margin vanished.
Vanished overnight. It led to mass insolvency. They failed to manage the duration mismatch effectively.
So duration mismatch is primarily a problem of profitability and solvency when rates surge. But even if banks use derivatives like interest rate swaps, to perfectly hedge that interest rate risk.
Converting their fixed-rate assets into synthetic variable rate ones.
They are still left vulnerable to the second, more profound threat, liquidity risk.
Liquidity risk is the risk of a run. It's the risk that you simply cannot roll over your short-term funding. The classic case here, which is highlighted in the source material, is the failure of Continental Illinois in 1984.
And it was a huge part of the 2007 financial crisis as well.
A decisive role. Continental Illinois was funding its long-term corporate loans using massive quantities of short-term, large denomination deposits. People called it hot money or wholesale funding.
Right. And this isn't retail customers like you and me.
No. Wholesale funding comes from sophisticated, large institutional investors, and they are extremely sensitive to any hint of trouble. Continental Illinois was solvent on paper, but when rumors of its exposure to bad loans started to spread, those sophisticated wholesale depositors simply refused to renew their short-term funding contracts.
The well ran dry.
Exactly. Even if the bank had been perfectly hedged against interest rate changes using swaps, it couldn't survive. It had long-term assets that couldn't be instantly sold without massive losses, and short-term liabilities that demanded immediate repayment.
It's an immediate fatal liquidity squeeze.
It is, and the core issue of the 2007 crisis was similar. You had institutions funding long-term, illiquid mortgage assets with short-term, very skittish repo funding. When counterparty trust evaporated, that funding market just seized up, leading to failures despite any attempts at rate hedging.
This means the entire edifice of complex finance, from our zero-curve derivation to convexity modeling, is ultimately a struggle to manage this inherent institutional mismatch.
It is. The mismatch between what customers demand in short-term liabilities and what they demand in long-term assets.
It connects everything back to that foundational risk.
It does. The most sophisticated financial institutions now deploy these complex monitoring systems just to analyze consumer behavior. They constantly fine-tune the rates they offer to depositors and borrowers by meticulously tracking where customers are choosing different maturities.
Because that reveals where the institutional mismatch is growing.
Exactly. It's an active, real-time risk management process, all driven by the market's preference for time and liquidity, as quantified by the very zero rates we just learned how to bootstrap.
This has been a transformative journey. We started with the foundational zero rates, moved through the elegant cascading logic of the bootstrap method to construct the pure interest rate curve.
And we use that curve to derive the market's highest expectations for future rates.
Then we mastered the essential tools of risk management duration as the linear estimate and convexity as the crucial curvature adjustment.
And we connected all of that complexity back to the catastrophic failures caused by simple maturity mismatches in major financial institutions.
Our synthesis today really confirms that these interest rate mechanics are the deep, structural language of financial risk.
They are. Whether a professional is pricing a complex interest rate swap or a commercial bank is deciding its mortgage policy, they are all structurally linked to the market's underlying perception of time and risk, as expressed through that zero curve.
So here's a final thought for you to take away. You now know that banks often fine-tune the rates they offer to you, the customer, based on monitoring small differences in the maturities of the assets and liabilities being chosen.
Mm-hmm.
So if you see two major competing banks offering slightly different rates, say one offers a one-year CD at 5.1% and the other at 5.0%, and at the same time they offer slightly different rates on a 5-year fixed mortgage, what fundamental interest rate theory are they trying to exploit or manage?
It's a great question.
Think about the liquidity preference theory. If one bank is desperate for long-term funding to ease its own internal mismatch, they might be willing to pay a little extra for that 5-year deposit, or charge a little more for a short-term loan, all to balance their duration exposure and reduce their reliance on that skittish wholesale funding.
That small, almost invisible difference in the consumer-facing rates is the bank pricing in its own anxiety about its structural stability.
It's a powerful lens through which to view the daily movements of finance. It turns every advertised rate you see into an indicator of internal risk.
It really does.
That's all for this deep dive. Thank you for joining us as we unpack the underlying DNA of the bond market. We'll be back next time with another stack of material ready to analyze.